All right, welcome to The Explainer. Today, we are going to pull back the curtain on a business that's, well, everywhere, but most of us don't really get how it works. We're going to figure out how insurance companies really make their money. I mean, think about it for a second. You hear about these massive payouts for natural disasters or health crises, totaling billions and billions of dollars. And yet, insurance companies are some of the wealthiest corporations on the planet. How in the world does that math work? Well, that's the puzzle we're going to solve together today.
So, first things first, where does all their money come from? The first and most obvious answer is probably the one you're thinking of right now: premiums.
Right. Every single policy they sell, whether it's for your health, your life, your car, you name it, comes with a premium. All those monthly or yearly payments from millions of customers flow into the company, creating this huge foundational river of cash. And the scale here is just mind-boggling. Let's just imagine for a second. If a company has 1 million customers and they each pay an average premium of 10,000 rupees a year, boom, that's 1,000 crore rupees flowing in. In the industry, they call this big part of money the gross written premium. Okay, but here's where it gets really clever. They don't just let that giant pile of cash sit in a bank account gathering dust. Oh no, they have a secret weapon to make that money work for them. And that weapon is investments. This little loop right here shows the absolute genius of the insurance business model. See, they collect all that premium money from you up front, but they don't have to pay out all the claims at once. That creates this massive pool of cash that's just sitting there, which is known as the float. And they take that float and invest it. This becomes their second incredibly powerful stream of income. So where does all this money go? Well, they spread it around. They invest in a whole portfolio of assets, safer things like government and corporate bonds, but also things with higher potential returns, like the stock market and even real estate. All of this generates interest, dividends, and capital gains. It kind of makes them as much of an investment firm as they are an insurance company. Okay, so we've seen how the money pours in, but that's only half the story, right? What about the money going out? Let's flip the coin and look at the other side of the ledger. Now, the single biggest cost, by a long shot, is exactly what you'd expect: paying claims. This is their core promise, after all. Covering your health costs, fixing your car after an accident, or paying out death benefits. That is the heart of their business, and naturally, their largest expense. Let's jump back to our little example. Out of that 1,000 crore they collected in premiums, a huge chunk, let's say around 650 crore, goes straight back out the door to customers who filed legitimate claims. But paying claims isn't their only cost, not by a long shot. Just like any other massive company, they have huge expenses just to keep the lights on and run the whole operation. This is all the stuff you'd imagine: paying their thousands of employees, renting office space, massive marketing budgets, and all the tech to make it work. And for insurers, a really big one is agent commissions. They spend a ton of money to incentivize agents to sell their policies. So in our example, let's say all of these operating expenses add up to another 200 crore. So you've got 650 crore for claims, and now 200 crore for costs. That means 850 crore of our initial 1,000 is already gone. Okay, so we've got the income streams, and we've got the two major types of expenses. Now, it's time for the big reveal. Let's put all these pieces together and see where the actual profit is really made. Now, to really get this, we first need to understand a really important term: underwriting profit. This is basically the profit a company makes just from the business of insurance itself. It's simply the premiums they took in, minus the claims they paid out, and the costs of running the business. The math here is pretty simple, right? We take our 1,000 crore in premiums, subtract the 650 for claims and the 200 for expenses, and we are left with an underwriting profit of 150 crore. But here's the crazy part. For a lot of insurance companies, this number is actually zero, or even a loss. They often pay out more in claims and expenses than they bring in from premium. So how can they possibly be profitable? Well, hold on, because we're not done yet. Remember that secret weapon we talked about? It's time to add the money they made from all those investments back into our equation. Let's say their investments earn them a cool 120 crore. When you add that to the underwriting profit, the whole picture just flips on its head. Suddenly, their profit jumps up to 270 crore. And that is the magic of the model. Even if their core insurance business just breaks even, their investment returns can make them wildly profitable. But hang on, what happens if there's a massive catastrophe? A once-in-a-century flood or earthquake? To protect themselves from that kind of thing, insurance companies, well, they buy their own insurance. It's called reinsurance, and it's one last crucial cost that protects them from enormous, unexpected losses.
So here it is, the final calculation. We start with that 270 crore operating profit. We subtract what they paid for reinsurance, maybe 30 crore. Then, of course, they have to pay their taxes, let's say another 60 crore. And what's left at the very end is the final net profit, 180 crore. That's the bottom line.
So, let's boil this all down. What is the actual blueprint for how an insurance company makes its money? It really comes down to these 5 steps. 1, you collect all the premiums you can upfront. 2, you invest that money as smartly as possible. 3, you pay out your claims over time. 4, you keep a tight grip on your operating costs. And 5, the real kicker, you use that investment income to supercharge your final profit. It's like running 2 businesses at once, one that manages risk and another that manages money. And this final thought just sums it all up perfectly. Insurance isn't just about risk, it's about cash flow, it's about patience, and it's about smart investing. So the next time you pay your premium, just remember, you're not only buying protection, you're also fueling one of the most fascinating financial engines in the world.